Very good afternoon to all of you. Due to some technical glitch, we are in mid of the starting of the webinar. We will be starting within next couple of minutes, within 2-3 minutes. So due to some technical glitch, we are not in a position to start, but we will within next 1 or 2 minutes, we will be able to start. Sorry for the inconvenience caused. Good afternoon to all of you. Good afternoon, sir. Good afternoon, sir. We are live, sir. We are already live, sir. Good afternoon. Namaste.
Good afternoon. Namaste.
Uh, Namaste. Sir, on behalf of AASB of ICI, I extend a warm welcome to you, sir, in today's webinar on standards on review engagement. First of all, I apologize for the technical glitch due to which we are starting it late. So, as we all are aware that the topic of today's webinar is very important, that is the standards on review engagements. And we are having two important standards, SRE 2400 revised, that is engagement to the review historical financial statements, and SRE 2410 review of interim financial information performed by the independent auditor of the entity. And in order to tackle this very important webinar and both the technical topics and both the SREs, we are having with us honorable and very learned speaker, CA Jitendra Agarwal ji. So on behalf of AASB of ICI, I extend my warm welcome to you once again, Jitendra sir. for this webinar and acceding to our request. I also welcome all the participants of today's webinar. Due to some urgent meeting of at various places, Honorable Chairman and Honorable Vice Chairman, AASB both are stuck up in the meeting. So I'm taking this liberty to start today's webinar. So before further we start this webinar, I would like to introduce our today's learned speaker, C. Jitendra Agarwal ji. Jitendra ji is a partner with the audit and assurance practice of the firm and is based out at the Deloitte office in Gurgaon. Jitendra ji has post-qualification experience of over 37 years with over 25 years as partner with Deloitte and leads with initiatives for the Deloitte Haskins and Sells. As the lead audit partner for some of the firm's largest clients, Jitendra sir has been responsible for the audit of several domestic and multinational companies, spanning across multiple sections, mainly automobiles, energy, and various resources, technology and media, manufacturing, and consumer business. In addition to this, Jitendra sir is an advisory and quality control partner on various other large clients of the firm. Jitendra sir has an in-depth knowledge and experience of reporting under various regulatory framework, including Indian GAAP, IFRS, US GAAP, and those of other significant capital markets. He has worked extensively on financial statement of audits carried out under the requirements of the Public Company Accounting Oversight Board, PCAOB, with the record of clean inspections. Jitendra ji has extensively advised companies, including public sector undertaking on IFRS implementation and conversions. Jitendra ji has been as an invitee member of Accounting Standard Board and Auditing and Assurance Standard Board of Institute of Chartered Accountant of India. He has been a regular speaker at various ISCI forums, and he has delivered many lectures, seminars, webinars, virtual CP meetings. During COVID period also, he has delivered many lectures on online basis. Jitendra ji is a fellow chartered accountant from Institute of Chartered Accountant of India and a commerce graduate honors from the Shriram College of Commerce, Delhi. Still, this is very vast, so I have cut short. So without wasting much more time, I request our today's learned speaker, Jitendra ji, to please deliberate on both the SREs. Over to you, sir, please.
Thank you very much for this very, very kind introduction and so many good words about myself. हम सबको थोड़ा थोड़ा एक्सपीरियंस है, तजुर्बा है, और हम सब अपने अपने काम कर रहे हैं. आई एम श्योर ऑल द पीपल हु आर ऑन दिस broadcast, who are listening to us, are all very proficient. They are doing their jobs. So I'm just one of you. Let me tell you that. आपके इतने अच्छे इंट्रोडक्शन के लिए बहुत बहुत धन्यवाद आपका. पर ऐसी कोई बात नहीं जितना आपने बताया. मैं भी एक साधारण चार्टर्ड अकाउंटेंट हूँ, हम सबकी तरह, जैसे हम लोग सब हैं. तो बिफोर आई स्टार्ट, मैं सबसे पहले आज बता दूं कि मैं पूजा में था, तो इसलिए मेरी वेशभूषा पूजा वाली है. तो बड़ी अच्छी बात है कि मैं पूजा से, दिवाली पूजा से निकल के और आप सब लोगों को संबोधित कर रहा हूं. और सबसे पहले मैं सारे अपने चार्टर्ड अकाउंटेंट्स को, सारे भाईजनों को, सारे बहनों को जो इस हमारे वेबिनार में हैं, सबको बहुत बहुत दिवाली की शुभकामनाएं देता हुआ स्टार्ट करूंगा.
आपको भी बहुत बहुत हैप्पी दिवाली सर.
आपके सारे परिवारजनों के लिए ये दिवाली बहुत मंगलमय हो, बहुत शुभ हो, बहुत सुख और समृद्धि लाए. तो इसके साथ आई विल स्टार्ट माय presentation. I will be taking one today. Somehow there was some confusion. मैं एक ही की तैयारी कर सका. एक मैं किसी और दिन ले लूंगा. I will ask Anil ji to make another appointment, and मैं जल्दी हाजिर हो जाऊंगा आपके सामने to do 2410.
Yes, sir.
I will do 2400 revised. So my apologies for that. So there was some confusion, but मैं ये करूंगा. I think I will do justice to my time because there is a sufficient amount of discussion to be done for this particular presentation. So with this, let me share my screen first, and I will put up a presentation. Just give me half a second. Is this presentation visible to everybody? Visible हो गई जी presentation?
Yes, sir.
Okay.
Yes, sir. Yes, it is visible, sir. Make it full screen, sir.
I'll just make it full screen. So I think now it has come full screen also. ये साइड में एक पैनल आ रहा है, मेरे को हटाना नहीं आता. So I will not tinker around with this. Let me see if I can drag this to one side.
Yes, sir. Fine, sir.
Bigger. So this is better now.
No, yes, yes. Perfect now. Now perfect, sir. Full हो गया.
हाँ जी, full हो गया ये. So this is my presentation for the engagements for reviewing historical financial statements, or as we can also say, historical financial information. This is the right time to do this presentation because we are in the middle of finalizing our limited reviews for the quarter and period ended September 2020, September 2023. This applies a lot to that, but the scope of this presentation is much larger than that, in the sense that this does not only cover the quarter end financial information or financial results, but this covers anything for which we need to issue a review report. So wherever there is a requirement by law or by request to issue a review report, that is where this standard is helpful. Now, what is the main purpose of reviewing a financial information? As all of us know that this is a review of financial information or financial statements, this is not an audit. So the assurance that we give is limited assurance and not reasonable assurance in terms of the financial statements that we review. Here, the practitioner, the chartered accountant or the auditor, he expresses a conclusion whether anything has come to his attention which causes the practitioner to believe that financial statements are not prepared in accordance with applicable financial reporting framework or it contains any financial misstatement. So this is a negative assurance report as compared to a fairly presented financial information report, which is there in terms of an audit. So this is the broad difference. So this is the main purpose of this SRE 2400. So we report on the financial statements as a whole and communicate as required by the SRE. Communicate means the report is issued as per the SRE. So what is the scope of this review, I would say, standard? Is that standard of reviewing engagements. In performing the review, we are required, yes, this is a review, but the review may be of a company, of a bank, of a financial institution, it may be of any entity. There may be other laws which are applicable to the entity that we are issuing the review report on. So the practitioner has to ensure that those legal or regulatory requirements are complied with. So that is the first thing. So those take precedence over the review report. So all the reviews are done. For example, if we are doing the review of a company accounts, then we have to make sure that the accounts are prepared in accordance with the accounting policies that have been set out by the accounting standards or by the Companies Act. So that is what we have to make sure. If we are doing a review for a banking or a non-banking financial company, there one has to make sure that the company has to make sure that the requirements of the Non-Banking Financial Companies Act are being adhered to, the banks are being adhered to. Similarly, there will be requirements of trust, there will be requirements of other organizations. So the legal or regulatory requirements, they are to be adhered to as the company prepares its financial statements or financial information. I'll tell you the simplest thing to tell you here is that when we do the limited review of a company for a quarter end, the requirements of SEBI are adhered to because there are regulation 33 and regulation 52. These two regulations are adhered to. The reporting format is as per them. There are certain asks as per the LODR which are adhered to. So all those matters are adhered to. So the legal and regulatory framework is very important as the financial statements and the financial results of entities are prepared. So this is the most critical thing. Then the other thing is that SQC1, this Standards on Quality Control, deals with the firm's responsibility to establish its system of quality control. So that is also critical. We have to make sure that the SQC1 requirements are adhered to as we do a review engagement under the SRE 2400. So this is a revised standard and a lot of things have come in. This is a modification of the earlier standard. all the new requirements have been included into this SRE 2400. Now, what are the requirements of the standard? So the requirements are to conduct a review engagement in accordance with this standard. So we'll be discussing, that's what we're discussing right now, what is the review engagement, and we'll come to that later on. We have to comply with the relevant requirements, whether it is the standards on quality control, whether it is the ethical requirements, whether these are requirements of SEBI, of Companies Act, of Non-Banking Financial Companies Act, so corporations. So all these requirements have to be adhered to. We have to also adhere to the ethical requirements, the Institute's Code of Ethics. For example, all of the practitioners who are doing the review, they have to be independent, they have to maintain confidentiality, they have to have proper documentation. So all the other requirements have to be fulfilled. Needless to say, it may be a review, but professional skepticism and professional judgment, that has to be adhered to. Skepticism is the bedrock of an audit or a review that we do. We cannot take shelter under the fact that this is a review engagement. We don't need to be as stringent. We can kind of ignore any particular issue. If supposing some matter comes to our attention which causes us to believe that the transaction is not above board, we have concerns on the transaction, we cannot say this is a review engagement, so we are ignoring this. That has to be brought to the attention of the management, of the shareholders, or that has to be corrected. One of the burning issues these days is on related party transactions. Now, a related party transaction, identification of related parties, reporting of related party transactions, ensuring that these are at arm's length, all that is part of your professional skepticism. I'm just giving an example. Professional judgment. The company makes a lot of estimates. We as auditors, or for auditors in an audit assignment or a review assignment, we have to ensure that all these professional judgments that we are taking based on the company's estimates are as per act, as per the requirements of various acts. These are as per the requirements of the accounting standards. These are fair, and they actually help in preparation of a complete set of financial statements which are free from doubt. So that is where our professional judgment comes in, and we have to exercise as much professional judgment as we do in the case of a normal audit engagement. Engagement level quality control. The quality control has to be as prescribed the standards of quality control. Again, there can be no we cannot let down on the standards of quality control, because that is what defines the quality of our work. Quality is the prime issue that we have to deal with when we do an audit. And one of the critical elements is doing the right tests, testing the transactions correctly, and documenting all the tests that the entity has done, and adhering with all the auditing standards, all the standards on auditing that are required for the review to be done. More than anything else, we have to also look at acceptance and continuance of client relationships and review engagements. So the client relationships, acceptance and continuance of clients is a very critical matter. If at any point of time the practitioner is of the view, for reasons which are known to him or which are public domain, that he should not carry on with the review of the client for an ethical issue or something which prohibits him, that he has to have complete documentation with him to make sure that the acceptance and continuance of client relationships is adequately and accurately documented, and that clients have been accepted after doing the appropriate due diligence. Needless to say, as we have in terms of our audit, there has to be an engagement letter with the client. What is the importance of an engagement letter? I will not delve upon it here. I'll just discuss it in brief, because that is a separate topic altogether. But this engagement letter has to specify what the auditor's responsibilities are, what the management responsibilities are, the objective of this review, because this is what sets out what we have accepted with our client, what the practitioner has agreed with the client, what he has accepted with the client. This is something which is a shield for the auditor or the or the reviewer, and it also sets out the entire responsibilities to avoid any disputes in future, and it provides legal protection to the practitioner. So the first thing that we need to set out in terms of the engagement letter is what is the objective and scope of the review engagement. This objective and scope comes out from SRE 2400. The objective is to carry out a limited assurance engagement, and it is done in accordance with a certain act or a certain law. In case of a company, it is in the case the overriding law is the Companies Act. In case of a listed company, it is a SEBI requirement, and the entire scope is defined by these laws. The identification of the applicable reporting framework. Now, the reporting framework is very important again. So we have to, as I said earlier, we have to define what is a reporting framework. Is it under Ind AS? Is it under Indian GAAP? Is it under some other act? It could be India IFRS. It could be US GAAP, or the case may be. So that is very critical for us to define. Intended use and distribution of financial statements and any restrictions on use or distribution where applicable. So the intended use this is particularly applicable in case there is a restriction on use. The limited review engagement may be performed for a particular specific reason, and there may be a restriction that has to be spelled out clearly, so that again there is no dispute later on. For example, if the financial information is only being given to its shareholders, it is only for consolidation purpose. It's not a general public statement. So all those things, all those matters have to be clearly specified in the engagement letter. There are instances where a review is done only for the purpose of consolidation into the parent's financial statements. It is not a general purpose statement. It is made with a view that this financial information will be consolidated. It may have been audited under some other law by another auditor, but the person who is doing a review is doing the consolidation of the issuing a report on consolidation may need to also include that. So in which case, certain carve-outs have to be given in the report. The engagement letter will also spell out the responsibilities of the management. These responsibilities are spelled out in paragraph 30B. Now, the responsibility of the management is to ensure that all controls have been appropriately implemented. There are proper controls in the organization. The responsibility of preparation of the financial results of the statements is of the management. The responsibility of the practitioner is just to review or audit the financial statements, including ensuring that all the relevant disclosures as required by law have been made and accurately made. So the responsibilities of the management have to be spelled out, the responsibility of the practitioner has to be spelled out. There is a very big confusion in today's world as to whose responsibility is there to prepare the financial statements or financial results. The outside world thinks, who are not so literate about the accounting profession, that the responsibilities of the auditor. That is what comes out here. The responsibility of the management is to ensure controls, is to ensure preparation and accurate preparation. It is just not preparation. And accurate means not only that all the presentation is correct. It doesn't mean that the accounting entries have been recorded, the results are fairly stated. It also means that whatever is required to be disclosed by law in terms of detailed disclosures, those have been disclosed and accurately and completely disclosed. So this is what the responsibility of the management is. The responsibility of the practitioner is to ensure that everything is complete and to ensure the judgments are correct, to ensure all audit procedures have been carried. That is the responsibility of the practitioner. This has to be clearly stated out in the engagement letter. An engagement letter, okay, let me just step back a bit. An engagement letter is a letter which is executed between the practitioner and the company, spelling out the roles and responsibilities and the framework in which the whole audit or review exercise has been conducted. The other aspect that has to come out in the engagement letter, that the engagement is not an audit. That is very clear. An audit requires a much higher level of work to be carried out as compared to a review. And the opinion that comes out of an audit is very differently worded as compared to a review report of the auditor. So that has to come out absolutely clear that the engagement is not an audit and the practitioner will not express an audit opinion. In fact, an auditor will give a review report, which is a negative assurance. So this fact has to be brought out in the engagement letter. And all these things also come out in the engagement, the review report issued by an auditor. The auditor also has to make a reference to the expected form and content of the report to be issued by the practitioner. And we also have to make a statement that this may differ, the report may differ from the actual form based on circumstances. They may be a modified report for all you know. Or there may be certain inclusions which may have to be made in the report by means of other matters paragraph. So that also comes in to say that there may be circumstances which the report may differ from its expected content and form. So that fact also has to come out in the engagement letter. An engagement letter is the first document that is signed between the practitioner and the auditor. So this is a very critical document. And today, when inspections take place, all these engagement letters, all this documentation is looked at by various regulators, be it NAFRA, be it in case of an inquiry, be it SFIO, be it MCA, whoever may be, all this documentation is looked at by all regulators. Needless to say, any review engagement, any audit engagement cannot be done without a proper engagement letter being signed between the two parties and in the appropriate desired format. After having done that, then we start with performing the engagement. This is the actual work which is being carried out as the practitioner performs the engagement. The practitioner's understanding as he performs the statement has to include all these matters that are listed on the slide, which says that the relevant industry, regulatory, and other external factors, including the applicable financial reporting framework, have to be understood by the regulator, by the practitioner. So any audit assignment, any review assignment cannot be done till the time the auditor is absolutely aware about the industry's regulation. As I said earlier, if a practitioner is doing the audit of an NBFC, there are certain requirements that have to be disclosed. If the auditor is doing the review engagement of a, bank or of an insurance company or of a normal corporate, the requirements are different. So all those aspects have to be understood because there are disclosures which get made by different different industries. Within finance, within a financial sector, if it is a microfinance company, they have different disclosures. So all that has to be understood. The complete regulatory factor, other external factors that could affect the industry have to be known. Recently, a few years back, we had COVID. Now we had the wars which are taking place between various countries. So a lot of companies in India, their operations will be affected by this war because they have branch offices or operations in these countries, and some have very large operations and a very large setup. So one has to be aware about all these matters so as to take a call on whether any impairment or any other entry or any disclosure is required in the books of account. So one has to be aware about industry, regulatory, external factors, and the applicable accounting framework. In lots of countries, the framework, for example, if in India, there is a company which is being audited, and there is a foreign company which is a subsidiary. So one has to make sure that the appropriate regulatory framework in that country has been adhered to. How does an Indian auditor know that? Or an Indian auditor would get to know because he would seek a report or a clearance from the statutory auditor of that relevant country's what you call that relevant company's auditor. So this is how one makes sure that all the regulatory aspects are being taken care of. The auditor also has to understand the entity's accounting system and accounting records. Now, certainly all the accounting systems and accounting records are the ones that we look at, that we rely upon, or that we audit as we do an audit or a review engagement. Also, having said that the practitioner should know all this, the practitioner would normally know all this in a continuing engagement because the auditor has been doing their engagement on a year-on-year basis. So he knows all the accounting records, accounting systems. But there could be situations when accounting systems change, or accounting systems could also be, refreshed or renewed or improved upon. So the accountant, the practitioner, has to ensure that the accounting systems and accounting records accurately reflect the transactions. If the accounting records and systems are the same, the practitioner will do an inquiry. He will also look at the accounting systems, do some walkthroughs, do some checks and balances, and ensure that they are the same and nothing has changed. So that is another aspect in performing engagement. The accounting systems and accounting records remain the same. The next aspect is the entity's selection and application of accounting policies. Now, it is very easy to say that the accounting policies have been specified in the accounting standards. It's not so simple. So the practitioner has to understand the accounting policies and see whether they are relevant in terms of the company's operations, size, industry, and many other factors have to be looked into while deciding on the accounting policies. For example, if there is an accounting policy on depreciation, the practitioner has to make sure that the company's estimates on depreciation are correct. There could be an accounting policy on impairment of receivables. Again, the practitioner has to see that the policy is correct in terms of the industry and in terms of the operations of the company. Selection of accounting policies is again very critical. A lot of accounting policy estimates are done in terms of expected credit loss method in various organizations. The practitioner has to see what controls does the organization have to ensure that the amounts which are there in the financial results, the provision amounts, are accurately reflected. Certainly, the nature of the entity has to be known, which is very critical, and materiality will be a determining factor in terms of the performing the review engagement. The materiality has to be determined for the year and for the quarter. The amount of materiality normally would remain the same, whether it is a review engagement or an audit engagement. Materiality also is determined once in a year and it is applied throughout the year. But if there are any changes in the materiality in any operation or any group of operations, in which case the materiality could be changed and should be worked out. And when a materiality during a quarter is changed, that may have to be appropriately disclosed in the books and documented in the books and recorded and informed to the those charged with governance if required. Now, in designing and performing procedures, the practitioner's inquiries of management and the others shall at minimum include the following. So if you notice that in a review engagement, the auditor, while doing a review engagement, relies on inquiries of management and carrying out analytical procedures. So we'll discuss both those aspects, inquiries of management and analytical procedures. But here I would like to discuss what would constitute an inquiry with the management. Accounting estimates. Again, we've talked about it earlier. The practitioner has to talk with the management that what are the significant accounting estimates and how have these been arrived at, and whether these comply with the applicable framework. A very simple accounting estimate for banks and financial institutions is the amount of impairment required for the loans that the company may have given, the bank may have given. Now look at a microfinance institution. It may have 10 lakh customers, 15 lakh customers, 20 lakh customers. In a normal company where there are less customers, one could do a review from customer to customer and say, okay, this person hasn't paid for 2 months or 3 months, he's exceeding his credit limit, he's exceeding his period of credit, and that is why this amount looks doubtful and a certain provision to be made. But when there are lakhs of millions of customers, how do you do that to each and every individual? So a certain model has to be developed. So this is all an estimate. So once the management makes an estimate of that model, it is the auditor's responsibility to ensure how the estimate has been made. The responsibility, please understand, the responsibility is of the management. It is of nobody else. Just give me a minute. The responsibility is of the management. The practitioner's responsibility is to ensure that the estimate has been correctly made and it accurately reflects the nature of the transactions. So the accounting estimates, this has to be done by discussion and by a review of underlying documentation, which rests with the client. Related party transactions. This is a matter which is being looked at by all regulators very with a tooth comb, very carefully and very critically. We are not doing it only because of the regulator, but this is where a lot of, I would say, manipulation could take place. Because if there are related party transactions, particularly in a listed company which are being done not at arm's length, so that affects the profitability of the company and is an unfair practice as far as the company is concerned. So the first and foremost thing is the identification. What are the controls over identification? If one of the parties which is charged of those charged with governance, one of the stakeholders, it could be directors, it could be the CFO, could be the CEO, or could be any senior management person, or one of the directors, or one of the, I would say, promoters. If they do not disclose a related party and have transactions with the related party, that could cause loss to the company in terms of financial as well as reputational loss. So one has to see that what is the basis or what is the process for identification of related parties. Having seen the process of related party identification, and there is a lot of skepticism involved in this. I'll come back to that in a while as we discuss this. A lot of skepticism is involved in identifying related parties. So once the auditor is comfortable, the practitioner is comfortable that the related party identification is correct, then ensure that all the transactions done with those related parties have appropriate approvals. Having ensured that the appropriate approvals are there, ensure that these transactions are done at arm's length. So these are all the steps that the practitioner has to take to ensure that the related party transactions are accurately accounted for. Then apart from this, the next step which a person has to take, that the practitioner has to take, is to ensure that all disclosures are there, all approvals are there. So these are some of the matters that one has to see in terms of related party transactions. And this can be done by discussion with the management, by making inquiries, as well as by checking documents. Coming back to skepticism on related party transactions, the auditor has to also ensure that the processes of identifying related parties are correct. And then as one is looking at related parties, go behind the veil and see that the party, if there is suspicion or there is doubt that this could be a related party, also go back And there are various ways in which the related party details can be picked out by discussion with the company, by getting the company to give data, and also by looking at various websites such as the MCA websites and others. The other inquiry which the practitioner has to do with the management is regarding any unusual or complex transactions that may have affected or may affect the entity's financial statements. So if the auditor would normally be aware of all the transactions or the nature of transactions which any company may be undergoing. If the practitioner comes across any transaction which is unusual, for example, there is one party which has come in and there are lots of transactions with them, or there is one single large transaction which is unusual, or the ratios of certain expenses are much higher than earlier, the cost of sales has decreased or increased, the income tax percentage, the tax percentage to PBT is very different, cash balances are very high, any of those unusual or complex transactions or any derivative transactions. So then the practitioners should inquire and figure out and take appropriate checks and make appropriate tests, look at documentation to see that the transactions are fairly presented and that they do not vitiate the financial statements of the company. Existence, the other inquiry which an auditor has to do is, has there been a fraud? So if an auditor is not expected to detect every fraud, the audit tests are not designed, or even the review tests are not designed to actually, pick up any frauds or to detect any frauds. So the first responsibility of the auditor is to see that there is a control mechanism within the company so that if any frauds take place, they are detected. So there has to be a prevent mechanism and a detect mechanism in terms of its controls. That is the first step an auditor has to take, that no frauds could occur in the normal course of business. The second step is to go and talk to those charged with governance, which is the CFO, CEO, and any other person, if they are aware of any fraud or illegal acts that may have taken place in the company. The management has the prime responsibility of ensuring that no frauds have taken place, and if a fraud has taken place, disclose it to the relevant people as may be required. There are requirements under the Companies Act to report to the Ministry of Corporate Affairs if the auditor has doubts that a fraud may have taken place and is able to establish a fraud. Certainly, there are monetary thresholds. It's not that every rupee of a fraud should be reported. There are monetary thresholds, but it has to be reported. So the auditor goes ahead and then takes a call as to whether he has to report it or not. And he has to make appropriate checks to ensure frauds have not taken place, and also inquire with management if they are aware of any fraud taking place. And all these things are also put up in the management representation letter. The other matter that an auditor has to look at is that there is non-compliance with provisions or laws or regulations, if any. And if there is any non-compliance, that also has to be reported. So this is another aspect that the auditor has to consider in his review report. Events occurring after the date of the financial statement. There is a full standard on post-balance sheet events. So again, all events that have occurred after the financial state, after the date of the financial, after the date of the report, after the date of the cutoff date for the financial statements are prepared. Any events occurring after that date which have an impact on the results which are being reported at the year end. So all those facts also have to be, all those events occurring after the date of the financial statement should be looked into by the auditor when the review report is being, when the review is being conducted. Some may have to be adjusted in which are called adjustments, may need to be adjusted, some may not need to be adjusted. So that judgment also is very critical. And whatever is done should be documented. That is the underlying message I would like to give all practitioners. Going concern. The management has to test if there are any going concern indicators. Any going concern indicators, any review, any impairment indicators, all that has to be tested by management. So if there are the first and foremost thing is that the management has to talk to the company talk to the auditee, and find out if they have controls to highlight any going concern issues. So it is the responsibility of the management to ensure that the entity will continue as a going concern. And we will test, as auditors, we will test those assumptions. So the first matter is that are there any indicators for going concern? For example, is the net worth significantly eroded? Are the current assets less than the current liabilities are far more than the current assets? In every situation, it may not be that net worth is eroded, still it is a going concern. Or if the current liabilities are in excess of current assets, it's a going concern. There could be mitigating circumstances. The auditor has to use his judgment to see that if there are any mitigating circumstances, he should test those. He should talk to the management and ensure that they're actually there. And also, this could be supported by the period after the date of the balance sheet, the cutoff date, as to what kind of transactions have taken place. So, going concern is a very critical element to be tested. Then perform analytical procedures. What do the analytical procedures do? What are analytical procedures? It helps the practitioner to obtain an understanding of the environment. For example, if one is doing a review engagement, analytical procedures could mean test the cost of sales to sales, test the tax to the tax expense to the profit before tax, test what kind of cash flows have in there. For analytical procedures, also test whether the numbers between the current year and the previous period have any discrepancies or any large variations. So how do these help? These help us to bring out any inconsistencies, any errors that would have crept into the financial statements, or identifying inconsistencies between periods. And if there are inconsistencies between periods, while testing while testing analytical procedures, then something could come up that there may be a transaction which has been wrongly processed, or one should be able to highlight reasons as to what has happened. For example, a lot of ratios got upset during the COVID days because either sales went down or costs shot up, traveling expenses completely disappeared. So these are the kind of factors which happened where the ratios got disturbed. So there has to be a reason if there is a variation. These also provide evidence in relation to any other analytical or any other inquiries that the practitioner may have performed. Contractual obligations. One has to inquire about contractual obligations as to is there any major commitment which the management has done, any major contract which the management may have entered into, any significant contingency that may have come up as a result of this contract, or any disclosure that may be required, or any entry that may need to be booked because the contract is an onerous contract. So the contractual obligations have to be inquired. Any material non-monetary transactions or transactions for no consideration have to be looked at. So all non-monetary transactions, any transactions which are material, have to be looked at while reviewing the financial, while making inquiries for the review process. Inquiry. In a review, inquiry, what does inquiry include? Inquiry includes seeking information. This is a very, very broad, high-level definition of inquiry. It includes seeking information of management and other person. That is management. Management could mean the senior management, maybe in a finance department, the CFO, in the talent department or the HR department, the head of people, the CPOs, chief people's officer. So any other person as may be required. In case of procurement department, the head of procurement, even people lower down in the procurement department. As the practitioner considers appropriate in the engagement circumstances. It also depends on which industry we are working in. If procurement is not a major activity in that company, then we may not look at the procurement officer in that depth. A financial industry company, for example, a finance company, may have, the treasury person as a very important person. So have a discussion with him. So as the practitioner considers appropriate, the practitioner may also extend inquiries to obtain non-financial data if appropriate. There may be cases where non-financial data is required. So it is the practitioner's, I would say, experience and responsibility to ensure that all data has been looked at. Evaluating the responses provided by the management is integral to the process. Now, lots of times into inquiries, the management gives some answers. Those answers have to be on the basis of certain foundation. A management just can't give any answer and get away. So management has to take responsibility of the answers it gives, because that is what makes us determine whether the financial statements have been properly presented or not. What are the various inquiries that we do of the management, and what is it that comes out of the inquiries? Now, some inquiries could be in terms of transactions, some inquiries could be in terms of not in terms of transactions, but generally as to is there any critical matter that has been discussed or approved at a board meeting, and what are the financial implications? Does that matter, which has been discussed or approved in the board meeting, does that matter affect the financial results or financial statements? There could be instances where the management has gone ahead and said that, okay, they have to close a certain plant down because it is not yielding the appropriate results, or the plant has been shut down because of a regulatory reason. For example, in Delhi, some years back, there was a regulation by the government that all polluting industries have to be shut down. So now, if that kind of a resolution comes about, so that is also part of our inquiry process. The auditor is aware about such a legislation, such a regulation. Then he has to ask the company as to what are their plans and accordingly provide for it. So a plant, if it is getting shut down, take a worst case scenario, if a plant is shut down because of a regulation, because of pollution, because of any other reason, or for example, in the car industry, they said all cars which are not complying with certain pollution norms, say BS4, BS3, BS2, whatever, if they're not complying with any norm, will not be produced in future by that company. So all machinery for that will need to be depreciated. So this is what we inquire. So what are the actions taken at the meetings of the promoters or the senior management or with those charged with governance and any committees, any proceedings? So all that is to be inquired. Now, inquiry doesn't mean that we've inquired, the management is at something, we've agreed with it, and we've kind of shut our review. No, it also would mean that after doing the inquiry, look at corroborative evidence which is there to prove that yes, nothing ever happened before this particular matter, which was closed, and accordingly you move ahead with that. So all actions taken at meetings of promoters with governance committees, those have to be inquired. Communication that the entity has received or it expect to receive from regulatory agencies. The audit is also to inquire if there is any communication from the tax department, from the company's department, from any other department, which could have an impact on the financial results. For example, if the tax department has given a notice to the company disallowing certain expenditure or levying a tax on the company or any penalty, then that has to be examined. So one has to check with the management whether anything has been received from any regulatory agency and effect that into the review process. What else we'll inquire is matters arising in the course of applying other procedures. While applying any other procedures, for example, if we are looking at bank balances, bank confirmations, if there is a difference, if anything comes up during the normal course of the audit, or one is doing a review of the sales ledger and one comes across the practitioner comes across certain large amounts being booked into the sales ledger. So all those matters will also be inquired by the practitioner. And not only by inquiry will he take a call, but also by looking at underlying documentation. Now, that was the inquiry process. Now we come to the analytical procedures. Now, in review performing, how does the analytical procedures assist the practitioner? It assists the practitioner, as I've already touched upon earlier, it assists the practitioner in obtaining and updating the understanding of the entity and its environment. And also it helps us to see whether any material misstatements could have occurred. As I just said a short time back, that at times the external environment could affect the company's results. So analytical procedures is help us determine that. It is not that again that we'll do analytical procedures, inquire from the management and shut it down. No. Underlying documentation wherever required while carrying out analytical procedures and inquiries have to be looked at. That is a given. Analytical procedures also help us in identifying inconsistencies or variances from expected trends. We could also do analytical procedures in relation to the actual results obtained vis-a-vis the budgets. So if the budgets have been set out by management and the actual results vary, by performing analytical procedures, we could talk to the management and find out as to what the reasons are, and then do testing around those reasons. Some of the analytical procedures, as I was told when I was still very young in the profession, that you have to check if a particular element of the profit and loss has increased over the last year, if it has decreased over the last year, and even if it has remained same. So it is not that once you do analytical procedures and there is no variation in a particular amount of expenditure, you will say, okay, this is fine, I move ahead. No, again, one has to check. For example, if sales have increased and traveling expenses and freight expenses have remained the same as last year, that is incorrect. So one has to go into those details also. So a whole lot of analytical procedures. Now, how does one define what analytical procedures to perform? That is based upon the practitioner's understanding of the environment of the entity, and also based upon the current facts and circumstances, and the way the industry has moved. For example, in a particular industry, say for example, it's the polyester industry, or it is the metals industry. If the rates have gone up, obviously the profits will go up. If the rates have gone down, the profits will go down. So all this information also has to be with the practitioner. He has to have a detailed understanding of the industry as he does the review engagement. Analytical procedures also help us in providing evidence in relation to any inquiry or analytical procedure already performed, and serves as additional procedures when the practitioner becomes aware of matters that cause the practitioner to believe that the financial statements may be materially misstated. So when there are reasons to believe that the financial statements could be materially misstated, analytical procedures will help us to corroborate that. An example of such an additional procedure is a comparative analysis of monthly revenue and cost figures across profit centers. So this is a very, very straight procedure which has been listed here. A company may have multiple divisions. Each division has a certain sales. It has certain cost of sales. So normally one would expect that the cost of sales would remain in line, from quarter to quarter and from year to year, other than for certain aberrations. So that is how an analytical procedure will help us, because if there is a variation, then one has to inquire and one will come across circumstances and facts as to why it is different. Going concern. A review includes consideration of the entity's ability to continue as a going concern. The practitioner shall cover the same period as that used by the management to make its assessment, or by law, where a longer period is specified. So a going concern assessment is made based on the underlying assumption is that the company or the entity will be able to sustain its operations or sustain its existence over the next 1 year. So that is an underlying assumption. But to do that, the company has to look at data which is there for more than a year. The first and foremost element is whether there are indicators that the company will not exist. Is it very highly leveraged? The company does not have repaying capacity. All those factors have to be considered, and a certain period is considered over which those transactions are looked at. So the auditor will review what the management has given and challenge if that is not correct. This may not have been given a lot of importance, but as years are progressing, and there are companies which have not performed well and have failed and have shut down, going concern takes a very critical position in terms of the audit, and the auditor has to make sure that it does all checks and balances and all tests that confirm that the company is a going concern. related parties. I've discussed this earlier at length. In the related party transactions, one has to make sure that all related parties are identified. There are controls for arm's length pricing, and all disclosures are accurately made. And this has to be skeptically looked at to ensure if there is anything unusual which has happened during the quarter, then one has to look at, whether that is a related party or not related. Lots of people, and I'll come back to related parties again. A lot of practitioners say that we rely on what the management has told us in terms of related parties. That really doesn't help. If the management has to do a fraud or those charged with governance, they collude, then it becomes difficult to say as to whether that control is adequate, that related party disclosure has been given. So one has to again look at various aspects. The first aspect being rather controls to ensure all related party transactions have been picked up and disclosed, or all related parties have been disclosed. So those controls have to be checked, first understood and then checked. So now, how does one get to know if there is an unusual transaction which could be a related party transaction? The practitioner identifies significant transactions outside the entity's normal course of business in course of performing the review. What does he look at? He looks at the nature of these transactions. The practitioner looks at whether related parties could be involved and the business rationale. Now, at times, there could be no business rationale for a particular transaction. A company has given a loan to a party and taken an advance, or a company has given a significant advance to one party to from which it is purchasing goods, whereas it is not given that advance to another party from which similar goods are being procured. So these are the kind of related party transactions. These are the kind of transactions, unusual transactions that could lead to a related party disclosure. The practitioner also uses work performed by others. For example, in case of a consolidation of a company's accounts, the auditor would use the work of another auditor to rely on the report. Now, what is to be looked at in these cases? One has to look at whether that other person has expertise in performing this particular engagement. So there are two levels of engagement which get done. One is, in one case, the practitioner relies upon the other person who is an auditor, who has a similar qualification, who is a chartered accountant. And in some cases, it may be another person who may not be an auditor or may not be a chartered accountant, but may have some other field of expertise. So one has to look at whether he possesses the necessary expertise to do that work. For example, for a cost audit, is there a cost accountant which is involved? For a secretarial audit, is a company secretary involved? So one has to look at this. So the practitioner may need to rely on work performed by others. While relying on work performed by others, the practitioner has to ensure that the person has the relevant expertise and that the report that other person has given has to have, a procedure which has been outlined in the report to confirm that the work has been done according to appropriate standards. So before relying on that work, for example, in case of an actuary, the actuary gives the data for the closing balances or provisions for employee benefits. So one has to see whether the actuary is appropriately qualified, he has the accurate data, and that the numbers that he has given make sense on an overall basis to the company's results. So that is what our responsibility is. And as the auditor communicates, the practitioner communicates with those charged with governance, he has to make this fact clear that the company has, that the practitioner has relied upon the other expert, and he has no reason to believe that the amounts which have been recorded based on the other expert's report have been accurately included in the results. But all that can be said only when appropriate due diligence measures have been performed by the practitioner himself. fraud with non-compliance with laws or regulations. Now, whenever there is any such evidence that there could be a fraud or there could be non-compliance with laws or regulations, immediately the matter should be discussed with those charged with governance, which is the audit committee or the head of the audit committee, as the case may be. The auditor should request for a management assessment of the same. What does the management think? What steps has the management taken to ensure that their fraud has not affected the company's financial statements? So the management's assessment for that fraud has to be done. Consider the effect, if any, on the management's assessment. Now, if the management has done an assessment and they've come up with a certain conclusion, then what is the effect of that on the financial statements? So consider the effect of that on the non-compliance with laws of the financial statements, and accordingly that has to be included in the conclusion of the practitioner's report. Determine whether there is any responsibility to report the occurrence or suspicion of fraud or illegal acts to a party outside the entity. If any other disclosure has to be made to a regulatory agency, for example, under the Companies Act, there is an obligation put on the practitioner to report to MCA, then the practitioner has to ensure that that is done. And these are matters which take a lot of deliberation, a lot of, I would say, thinking and ensuring that the appropriate disclosures are made to the regulatory agencies. Work documented is work not done. That is a very clear principle, which is there as far as all audits are concerned. So ensure that all work which has been done is appropriately documented. Now, there may be certain additional procedures which the practitioner may need to perform in case he gets to know, or if there is evidence that the numbers could be misstated. So the practitioner should design and perform additional procedures to be sufficient to enable the practitioner to conclude that the matter is not likely to cause the financial statements to be misstated, or determine that the matters causes the financial statement to be materially misstated. So the practice has to ensure that if there is anything which comes to his attention that could cause him to believe that the financial results could be misstated, or the financial statements could be misstated in terms of the profit or loss, assets or liabilities, or disclosures, he should make sure that he performs additional procedures around. Similarly, a practitioner also has to look at all subsequent events as he does the audit or review, as he does the review of financial statements. He has to make sure that all subsequent events have been accounted for. There are ways in which it is done. One has to look at procedures like review of bank statements, review of minutes of the meetings, review of the ledgers. So all those things have to be looked at. Or if he's aware about any thing in the public domain, lots of practitioners, they have alerts which come to them from various websites. Could be Google, could be the company's website, or any material event. So all those things have to be looked at by looking at subsequent events. The practitioner should obtain written representations from management that the management had fulfilled all its responsibilities which have been described in the engagement letter. So these representations also are prescribed in a certain format by the Institute of Chartered Accountants. So all those have to be taken into account before the report is concluded. This is about representations. Now, these are the specific elements which have to be included in the representation, that management has fulfilled its responsibility for the preparation of financial statements in accordance with the applicable financial reporting framework, including where relevant, their fair presentation, and has provided the practitioner with all relevant information. Now, the practitioner will rely on information that he has got from management. Now, if the management does not give information, or if the auditor is not able to pull out information from the management, it is the responsibility of the management first of all. So that is the foremost underlying matter, that the management has to say that they've given all information. then the management also has to give a representation to the effect that all transactions have been recorded and reflected in the financial statements, and that all laws have been adhered to. So all these matters have to be given, because that is the first primary responsibility of the management, to make sure that all laws and controls are in place. So the management has to give representation around all that. This does not absolve the auditor of his responsibility of carrying out an audit. But the point is that these are critical, because otherwise the management can say that, okay, I was aware about anything, but you guys didn't check for it. So if a management gives a representation on all these matters, then it is completely the management's responsibility. Subsequent events. If the practitioner becomes aware of events occurring between the date of the financial statements and date of signing of the report, so, and if that may have an impact on the financial statements as at that particular period end, those have to be disclosed in the financial statements. Those have to be disclosed and given effect to the financial statements. At times, there could only be a disclosure requirement. For example, the company may have acquired another company subsequent to the year. And so it may just be a disclosure requirement and it may not have an impact on the numbers, but still that will need to be disclosed. Right. So the practitioner has no responsibility to perform any procedures regarding the financial statements after the date of the practitioner report. However, if after the date of the report, if after the date of the financial statement, but before the report is issued, a fact has come to be known that had it been known to the practitioner at the date of the practitioner's report, may have caused the practitioner to amend the report. In case, okay, let me just put it simply. In case a fact is known to a partner later, that a fact had taken place and that could affect the financial statements, then he has to go and discuss and that has not been disclosed to the auditor. He has to discuss that with the management and also determine if the financial statements need amendment and inquire as to how the management would address that matter. So this is another issue which would come up, and then he has to accordingly take action on that after appropriate discussion with management. Having done all this work, having done all the work that we have described, having done all the procedures that a practitioner is required to do, finally the practitioner has to conclude and report. So the report will include a clear written expression of negative assurance, as I've already said earlier. He should review and assess the conclusions drawn from the evidence obtained on the basis of negative assurance. So if the auditor has no reason to believe that anything wrong has happened, he will say, I have no reason to believe that there is anything that these statements have been prepared, have not been accurately presented. So there is a certain language which is prescribed, and the auditor is required to use that language. Now, these are the contents of the report. So the report shall state that nothing has come to the practitioner's attention based on the review of the financial statements that causes the practitioner to believe that the financial statements do not give a true and fair view or are not fairly presented in accordance with the applicable framework. Or if matters have come to the practitioner's attention, describe those matters in the report and express a modification of the negative assurance. But when the matter is pervasive, now this is a reporting standard requirement, when the matter is pervasive, then he may have to give a negative disclaimer or a negative. In case there is a material scope limitation, the practitioner has not been given documents. This would also accordingly have to be addressed, and in such a case, a disclaimer will need to be issued. There is another fact which goes into the report is the emphasis of matter and other matters paragraph. So these are two matters where an auditor has to express or has to disclose a material transaction or a material event which has happened. He can do so by not qualifying the report or not modifying the report, but by just highlighting that matter in the report. And there are certain matters which are clarificatory, which an auditor has to give. These are called other matters. For example, if the auditor has relied on another auditor for the audit of a subsidiary, the person, the auditor of the subsidiary, he has relied on the auditor's report. He has to state that he has relied upon the auditor's report for this revenue or for this particular, I would say, asset or profit or cash flows on the auditor's report and included that in the consolidated financial results. This is just disclosed as another matters paragraph, and this is not a modification in that. So this is all that I had to present in this presentation. I hope this has made meaning. It is relevant for all review engagements that we carry out. And the others, the other slides are appendices, which give, reports on unmodified conclusions, reports with modified conclusions, various paragraphs, reports on special purpose financial statements. And these are all put in the, I would say, the standard. So I would not like to discuss this, but the material elements is what I've discussed. I'm happy to take any questions as you may have, and happy to address those. Over to you, sir. Is Mr. Anil on the call?
Thank you, sir. Thank you so much, sir. Sir, can you hear me?
Yes, now we can hear you.
Sir, I have received certain questions. May I ask, sir, those questions?
Please, by all means. I will say
Yes.
whatever I can address, I will address. In case I can't address something, then I can always get back to the relevant practitioners.
Sir, when we do off the line professional services other than audit, tax, etc., what does standards on engagement in this case? When you say review such engagements, what are we required to address? That is one MOU between the industry and government, or MOU between industry and industry, etc.
I could not understand this question. Sorry, can you just clarify this question to me?
I'm just
other engagements other than
sir,
the audit engagements.
When we do off, sir, member is asking when we are doing off the line professional services other than audit, tax, etc.
Okay, fine. Other than audit, tax, etc. Yes.
Yes, other than audit and tax, etc. So work. Then what does the standards on engagement in this case? When you say review such engagements, what are we required to address in that case?
So if I can understand the question correct, if we are doing other engagements which are non-audit engagements, then what are we expected to review? Is that right?
Yes, sir. Yes, sir.
So it depends on what the ask of the particular law is, or what the ask of the statute is. So if one is doing a review engagement, for example, one has to do some certification or issue a certificate in accordance with a particular requirement of a law, say an export-import law. Then one has to look into the requirement and then do a review as per that requirement. That is what is there. So it is not between industry and industry, it is between the company and the particular law under which that assurance has to be provided. Lots of cases come to practitioners where they say that this company is now winding up. It needs a certificate. Now, this is not under any law. It is not under any audit, requirement. So it needs a certificate that all its liabilities have been settled. Now, this is the requirement maybe of, say, a regulator which is winding up the industry, which is winding up that company. So then that particular requirement has to be looked at, that law has to be studied, and a review or an audit or a limited assurance or reasonable assurance certification has to be issued. So it is that particular law which defines what you are required to.
Yes. Sir, are there any specific restrictions on review engagements?
Such as, I couldn't, again, could you be more specific? Any restrictions in which ways? Normally, a review engagement is carried out by an auditor of the company. Normally. But if supposing somebody comes to any chartered accountant and says, do a review engagement for me for a particular activity, he can do it if he is able to understand the terms of the engagement and do the required procedures as per SRE 2400. He can do that.
Ji, sir. Sir, do we need to perform review of accounting policies during review engagements?
Well, we make a statement that the accounting policies are the same as they were for the earlier audited results in most cases. One will have to do a review of accounting policy. Supposing if he's not doing the audit of a company or he's not done it for the last quarter, he's just doing a specific review engagement, the practitioner will have to do a review of the accounting policies to ensure that the accounting policies are just, they are not, and they're in accordance with law. It should not be that the accounting policies are not in accordance with law. So the review of accounting policies has to be done. For example, the company may say that I will charge depreciation, say for computers over a period of 10 years, whereas normally the depreciation on computers is done over a period of 3 to 5 years. So if there is anything unreasonable, that has to be looked at.
Yes, sir. So one member is asking your expert opinion or your expert advice while applying the standards on review engagements. What auditors need to check?
The auditors need to do a review as per this process. You do analytical procedure inquiries. This is a very open-ended question. So if one can be specific, I'll be happy to address that. The procedures are specified. I'll tell you, I'll tell you a brief genesis of this standard.
Yes, sir.
Long many years back, say about 2 decades back, or maybe more than that, the senior management would ask its finance team to let them know as to what are the results at the end of a quarter, at the end of a month, at the end of a quarter, at the end of a half year. So management would have to prepare a set of results and give it. Unfortunately, in those years, accounting practices were not so robust. The accounting softwares were not so robust. Like today we have SAP. It gives us a lot more information. So what accountants would do is in the absence of any information available to them or a lot of information not being available to them, they would just pull out numbers from the ledger and put it and give it. So at the end of the year, when the senior management or the promoters would compare the results with the actuals, if they would add up all the 3 quarters and then compare it with the financial statements at the end of the year, the variation would be very large. Then there came a concept that, okay, if a review is conducted by an independent party to make sure that these numbers are correct, and just by looking at the broad books, the ledger balances, and by making inquiries or by doing analytical procedure, then that will help a long way to have a accurate set of results. So that is how this review started off. So I was part of that time of the reviews, and I used to do it myself. And we at that time thought that it's a very very high level thing, and it will not achieve any results. But today it has achieved a lot of results. So that was the genesis.
Yes.
So that is where the standard got formed. And if you remember, the first standard was formed with effect from 2010, and then this was revised later on, the current one.
Yes, yes. So thank you so much, sir. Now we come to an end. Thank you so much. Other questions, what we will receive, I'll forward to you for your expert advice, and I'll forward the same to the concerned member. So please, at the end, I would like to extend our heartiest thanks towards you for sparing your valuable time as well as enlightening all of us on these SREs, various intricacies relating to the SREs, as well as on this festive season. You have given us time and you are always available, sir. Thank you so much. Whenever I call you, you always give your kind consent to address for the members. And again, out of the very busy schedule today, as well as the puja also, you have given me time, sir. Thank you so much. And once again, on behalf of AASB of ICI, wish you very, very happy Diwali and very happy festive season. And to all the participants also, wishing you very, very happy Diwali and happy festive season, sir. Thank you so much, sir. Thank you so much, sir.
Thank you so much. Always happy to be part of the institute.
Thank you so much, sir. Thank you, sir. Thank you. Thank you.
Recording